Good afternoon, members of the board. Thank you for your time today. We are here to present Chester Corporation's Round 2 performance results and outline how the company is transitioning from recovery into structured growth. Round 2 represents a pivotal moment for Chester. After an unstable Round 1, we focused on restoring profitability, stabilizing operations, and building a strong financial foundation to support expansion. I'm pleased to report that those objectives were achieved. Let's begin with our executive summary. Sales increased from $7.9 million in Round 1 to $56 million in Round 2. That is nearly 7 times revenue growth in a single round. Net income increased from $188,000 to $5.6 million, a nearly 30-fold improvement. Return on sales reached 10.1%, the highest in the industry. This confirms that our pricing discipline and cost control strategies are working. Our stock price increased 53%, rising from $14.15 to $21.62. This reflects market confidence in the company's recovery trajectory. Return on assets improved to 11.5%, exceeding the industry average of 10.3%. Additionally, our bond rating remained tied for best at BB, demonstrating financial credibility. However, despite strong profitability metrics, our market share is 12.1%, ranking us 5th out of 6 competitors. Round 2 proved that Chester can operate profitably. Round 3 must demonstrate that we can convert profitability into market leadership. Let's discuss what specifically drove this turnaround. First, disciplined pricing. We avoided aggressive discounting and instead protected contribution markets. Second, cost structure alignment. We ensured production volumes match realistic expectations, avoiding excess inventory. In fact, we ended round 2 with 0 inventory. Every unit we produced was sold. That is an important signal demand for our product exists. Third, strategic capital investment. Cash declined from $17.4 million to $13.9 million. However, this was not due to operational weakness. We invested $12.1 million into plant capacity expansion. This was a proactive move to prepare for higher output in future rounds. The market responded positively. The 3% increase in stock price confirms that investors believe Chester is no longer stabilizing. We are positioning for growth. Now, let's examine our regional performance. The Americas represent 58% of our revenue. We generated $32.5 million in sales with a strong 19% in net margin. While this is profitable, 10.7% market share trails Andrews 21% and Ferris 23.7%. There is clear room for expansion. Europe represents 31% of revenue and is our highest margin region at 29%. Only 2 competitors are seriously active in this region. Additionally, the budget segment in Europe is growing at 18% annually. This is a high opportunity market with manageable competition. Asia Pacific currently represents 11% of revenue. Sales reach $6.2 million with a 6% margin. While margins are lower due to period costs being spread over a smaller sales volume, this region is growing at over 40% annually. It is early stage, but strategically important. The key takeaway is this: Chester is profitable in all 3 regions. But profitability alone is not sufficient. We must now pursue disciplined expansion.
While round 2 demonstrates strong recovery, our competitive position shows that further action is required to strengthen market share and long-term advantage. Let's start with the competitive landscape. Andrews leads the industry with 27.6% market share and dominates Europe with over 60% share in some segments. They operate multiple products and are regionally diversified. Ferris holds 20.4% market share and maintains significant production capacity. They compete aggressively in the Americas and the Asia Pacific. Erie achieves the highest ROA in the industry at 22.9%, focusing primarily on the Americas with strong efficiency. Chester differentiates itself through profitability. Our return on sales of 10.1% is the second highest in the industry. That indicates strong internal discipline. However, we are currently competing with only one revenue-generating product, cake. Meanwhile, competitors operate broader portfolios. This creates a structural limitation on our growth. Now let's address our primary challenges. The first issue is underinvestment in marketing. Cake awareness is 42% in the Americas and only 18% in both Europe and the Asia Pacific. Industry competitors average between 80 and 97% awareness. This gap likely resulted in approximately $20 million in unmet demand. Customers cannot purchase what they do not recognize. The second issue is the execution of the product portfolio. Candy and Karma were successfully developed in R&D. However, neither product generated revenue in round 2 because they were not launched with production, pricing, or marketing support. This represents approximately $2 million in R&D investment with zero return so far. The third issue is product positioning drift. Cake currently sits at speed 5.3 and accuracy 5.3. The budget segment center has shifted toward 6.3 and 6.3. Each round we delay repositioning, Cake loses buying criteria points and competitive attractiveness. These challenges are execution-based, not structural. Now let's discuss our round 3 strategy. First, we will significantly increase marketing investment. Promo and sale budgets will be tripled across all regions. Our objective is to achieve at least 60% awareness in the Americas and to build brand recognition in Europe and the Asia Pacific aggressively. Second, we will launch Candy and Karma into full production. Candy will target the budget and mid-range segments, leveraging existing demand momentum. Karma will target the performance segment to expand our competitive footprint. This will move Chester from a single product company to a 3-product competitor. Third, we will reposition Cake to 6.3 and 6.3 to align with the round 3 budget segment center. We will reduce the service life to 17,000 to accelerate revision timing and maintain alignment with the buying criteria. Fourth, we will prioritize European expansion. There are 842 units of unmet budget demand in Europe, and only Andrews competes seriously there. Increased marketing and production allocation toward Europe represents a high probability growth opportunity. Now let me conclude with our outlook. Round 2 proved that Chester can recover. Profit increased 30-fold. Margins lead the industry. Every unit produced was sold. Round 3 is about scaling. Our strategic direction is clear. Increase marketing to build awareness, expand our product portfolio, align product specifications with segment movement, and pursue high-margin European growth. We expect the following outcomes: higher market share across all regions, sustained profitability as volume increases and fixed costs are absorbed, improved competitive positioning relative to Andrews and Ferris, continued stock price appreciation, and measurable gains in shareholder value. Chester is no longer in recovery mode. We are entering disciplined expansion. Thank you. We welcome your questions.